Hi, ready? Okay, guys and girls, we are on the Coalface with mortgage broker Mark Conway talking about what everyone's talking about. What's happening with interest rates, the weirdest thing. So stay tuned. We're going to talk to Mark Conway right now. Not quite 7:45, but that's all right.
All right.
Yeah.
Good morning,
so we're
gents.
going to road trip. We're going to say we've got Billy Drury, salesperson. We've got Wayne Hughes, business consultant. We've got Mark Conway, mortgage broker, and we've got Mark Novak,
real estate extraordinaire.
Yeah, he's a good bloke.
That's right.
Good bloke. So, what's on your mind to ask the mortgage broker, gents? And this is a live show. Anyone that wants to ask away.
Yeah, Mark, good morning. Thanks for joining us. Wayne, thank you too. Was this expected? Because we had mixed sort of what was foreseen, expectations, and then all of a sudden they've paused it finally.
Yeah, they paused it because the inflation figures are looking a little bit better, but the major banks were very 50-50 on what they both thought. And Philip Lowe, the Reserve Bank governor, has basically said he's going to review again next month, and they're looking for a little bit more data before they can continue either pausing or raising rates in the near future. And they're now predicting 2024, 2025 is when the rates will actually come down. So we're in interesting times at the moment, and a lot of the banks have started reducing some of their fixed rates, just 1, 2, and 3 years, just to be a bit more competitive. And that shows that we're almost at the top of the cycle at the moment.
It was really interesting, Mark, the Australian Financial Review last Wednesday or Thursday, I think it was Thursday last week on the 29th. They were just saying too close to call 50-50. And so all the bank and the AFR were all saying, we just don't know where this one's going. And that was only 3 days out from the announcement. So the other thing that links in, and the other thing that links in with this, I saw a report a few days back from the Australian Bureau of Statistics saying that for the second consecutive month, inflation had fallen under what was the preceding month. And so that meets their definition of inflation having gone over the top of the cycle.
That's exactly right. So most of the banks are still predicting maybe one more rate increase. They just don't know when. And it does feel like we're almost at the top of the cycle at the moment as well, which is very good for budgeting for a lot of people as well, thinking how much is this going to keep costing? It's $70, $100 every single month. Some people's payments have gone up, $1,000, $1,500 a month as well at the moment. So it's tough to call about what's going to happen in the next quarter or even throughout the rest of this calendar year, but it does feel like we're almost at the top of the cycle.
So
Mark Conway, broker on today, guys, talking about what he's saying on the Coalface with mortgages if you've just tuned in.
Yeah.
Sorry, Wayne, what were you going to say?
So, Mark, one of the other comments that Philip Lowe made when he was at the press club was about they were looking very closely at the rental rates at the moment.
They were looking at correct, yes.
Yeah,
really?
Yeah, they said that that's one of the things in their clear focus. But Mark, one of the things that I guess question for you is that for us old enough, not like Billy here, but for us old enough in the market, we've seen rates way higher than where they are at the moment, and yet we were still buying houses and things. And with rent going the way it is, are you getting approached yet by any people saying, can I skip across from renting to buying? Because that's bound to come at some point in the next 12 months.
It is. Not a lot of tenants have decided to buy recently. I think they're struggling with rising rents as it is. And a lot of those people don't seem to have as much cash lying around as other people that are actively in the market. And speaking of the market, it seems that open homes are really busy at the moment, and some property prices have already increased as well. And we're seeing that in several different demographics of Sydney at the moment as well, where unexpectedly properties are selling for more than they would have been, 2 or 3 months ago.
Yeah.
So it feels like people are getting used to the cost of funds.
Billy, what are you going? Why are you so quiet?
I've got a question.
Yes.
What is normal these days for the cash rate? It didn't seem normal to have it at 17% many moons ago, and it didn't seem normal to have it at 0% where money was free. So what is normal? What's the long-term forecast?
The long-term forecast is money to cost a borrower, high 3s to the early 4s. That's the historical average that they've been talking about lately in a couple of different articles. That would be a cash rate of give or take 2%. We're at 3.6% at the moment. And then what they're talking about is those 7 rate decreases that they have spoken about a couple of times would bring that cash rate from 3.6 back to around that 2%. And that's in line with 2 to 3% inflation as well.
Do you get people freaking out when they call you, or are they shitting the bed? Do they call and say, mate, what do I do? Help? Or is there, in most part of it, sort of calmness out there?
So I've asked that question to lots of brokers as well that I speak to all the time. Have they had many clients freaking out, or have they been getting any distressing phone calls? And we haven't really. And the answer is we actually haven't seen it. Surprisingly, there's a few demographic areas where we don't have so much of a customer footprint, and I'm thinking that some of those socio-economic areas might be suffering worse than the eastern suburbs, North Shore, northern beaches of Sydney, where me and some of the other guys I work with have predominant most of our clients as well.
Not according to the chief economist of CBA. He agrees with you.
He agrees with me.
He agrees with you.
Right.
And we did an interview with him one-on-one, and he was saying it has gone up a touch, but nothing concerning for CBA.
Yeah. They seem to think people have got a lot of money in offset and savings. That's what the RBA seems to think, and that's what the banks are telling the RBA from the data perspective. However, that means no holidays. You're eating up all your savings to cater for the high mortgage repayments.
Yeah.
And in a period of time, everyone's cash will be exhausted. And I think some people borrowed to meet the market, and I think that's what's going to exhaust their savings because their debt level is that little bit higher than they probably would have liked. They did keep a little bit of a buffer, but we'll see if that gets eaten up over the foreseeable future.
I'm pretty good when I'm committed.
Yeah.
I go good. And in all seriousness, I think if people have committed to have got mortgage stress, in most part, it's a healthy commitment. It's not like they've mortgaged if it's naughty debt, of course you're going to be in trouble. But if it's good debt, I think in most part people fight for shelter, they fight for food. They do the right thing. So I think we should. It looks like so far we're okay.
That's right. I mean, if you've weathered the past 6 months, you can keep weathering it because we're almost at the top of the cost of funds. And I just think they're probably tightening their budget, dealing with higher rents, or they're dealing with higher utility bills, things like that. So, and just like what Wayne said, it was rent. It was also the cost of living that the RBA was focusing on at the moment as well, where they're trying to be a little bit more mindful of some of their rate increases, while staying resolute to making sure that inflation comes back down to a reasonable period.
I like that word, resolute.
Resolute.
Mark, another thing, are you seeing much difference between the product offerings at the moment between the big four banks and the next tier banks? So is there an opportunity for them to be innovative with their products?
I'm finding that they're all quite similar at the moment. Well, there's a little bit of a variance in servicing, and pricing from the small banks to the big banks is a bit closer than it used to have been. But big loans with a low risk profile, so a low LVR, are being priced a bit more aggressively as well. And we're also finding literally 90+% of people are happy to stay on a variable. They don't want to commit to a fixed rate, even if it's a 1 or a 2 year fixed rate. Unless it's for an investment property where they're just happy to have that debt sitting on mid to high 5% and be done for the next 24 months.
So
There's
I
a-
guess midterm, that's probably the biggest change that would have happened. But people fixing,
That's right, yeah. And then this impending mortgage cliff. Most people I speak to have been well prepared for this. They've been putting a bit of cash on the side, or they've just done some of their budgets on the mid fives coming off the high ones. So a lot of people with a sub 2% fixed rate coming off in the next one year to 18 months.
And the biggest
Is
question,
there any sort of sector of the market that just is not looking for finance at the moment, not interested about buying, i.e. investors?
From our perspective, it's just generally high net worth people that don't need funding. But we're seeing a little bit more competitive,
like Wayne.
Yeah, and we're seeing a bit more competitiveness at some of the high-end auctions at the moment, where some of those people they're unaffected by the cost of funds, or their business has just gone from strength to strength in the last couple of years.
But anyone where you were good, like say for example, when money was at its cheapest, what was the majority of your sort of clientele looking like? What were they using the funds for? Was it an investment versus what is it now? Is it owner occupiers?
It's probably a bit of a mixed.
That's a great question.
It's a bit of a mixed bag.
Yeah. Has the shopping list changed?
No, the shopping list hasn't really changed. It's all about the intention, and the intention has always been very similar.
Yeah.
We're either investing or we're buying somewhere to live. We'd like to keep our existing properties. The rental market is good. Banks are assessing the cost of the property, but they're also taking a really high 80 or 90% of your rental income.
Oh, really?
Yeah, so that makes a big difference as well.
They used to shade it.
They used to shade
25, 30%.
Yeah, some banks need up to 30% off your rent, but they'll still take 100% of the costs. So they're double dipping there to a degree. And in a rising rental market, that seems a little bit unfair as well. So going to a lender that uses 80 or 90% of investment income can increase your borrowing power substantially as well.
That's interesting.
Yeah, that's another 20% of your income. That's
right,
huge. Yeah.
So Mark,
and it's hard to keep those investment properties now than it used to be.
And Mark, along that line as well, are you seeing the valuations of property coming in with the bank valuers being extremely conservative at the moment, or are they being realistic given what people are paying for properties?
Boys, you got some great questions today. Jesus Christ.
Sorry, Mark, putting you on the spot here. What were you asking?
I love it.
What we are seeing is when you do a refinance or an equity position, that the bank's valuers are cherry picking all the low fruit from the comparable sales. They're being ultra conservative. I'm doing 3 and 4 and 5 valuations with different lenders to try and squeeze another 50 grand of equity if I'm looking for some cash to do something else for someone. So we're not just staying with the one bank. We're doing lots of upfront free valuations. If we need to pay for them, we're subsidising those as well, just to see if we can make sure that we can get a really good result, because we are seeing quite a variance in valuations.
And great plug for you here, because that's why people should use a broker and someone like yourself, rather than just going back to the bank and just like, you talk to me. There's no substitute. It amazes me why people go to the banks directly when they should be coming through someone like you and getting comparatives.
Exactly right. Yeah.
So what's the difference? What's the biggest difference you've seen in some of these valuations coming back?
Probably 15% variation from highest to lowest. In Victoria and New South Wales, not so much in Queensland, but I have seen some really, really big variances, especially on
easy make or break on a deal.
Well, it could be the difference in $50,000 or $100,000 in equity. You might really need that equity if you want to keep that property and buy a house to live in. House prices have obviously come down a little bit, but now there's a bit more competition with families looking to secure something.
Yeah, really interesting.
Yeah.
That's our 5-minute cover that went for 14 minutes on mortgages. But really clever question, and I think the questions that were represented by everyone today are the ones that are really out there in the community. So it's good just to have a bouncing board like Mark. Thanks, buddy, for coming in.
Not a problem. Thanks for having me.
We're doing a road trip.
Yes.
We can see some supplies.
Just remember,
backseat, yes.
Yeah.
The back seat's got a coffee machine, and it's got the biggest piece of bread you've ever seen. So this is almost half a metre long of bread from Iggy's. Serbian. He's Serbian.
Is he?
I swear to God.
No.
Yeah, I swear to God.
Really?
Iggy's is Serbian. I'm googling it. Iggy's breads. Best bread in Sydney.
That's right. Yes.
Yeah. We're gonna get a coughs.
Yeah. All right.
With our
Happy
family.
Easter, guys.
It's not the guys.
Yeah. I have a coffee machine in my car as well in case his breaks down, and we really like our coffee.
Oh, big coffee people.
Big coffee
Big
people.
coffee people. All right, guys.
All right.
Everyone hopefully helped you today.
Rolling
Love ya.
out.
See ya.
Thank you. Bye-bye.
Bye.